the credit system that we've seen for a little while. And,
Mhm.
quite honestly, it's going to be followed by more and more and more. And the reason it'll be followed by more and more and more is we have a debt bubble. Well, it's a debt come credit bubble in the markets. They always burst.
Mhm.
Credit bubbles always burst. I don't know when this one will burst. Might burst next month. Might burst next week. It might burst early next year. But credit bubble it is. And when it bursts, what does the Fed and the US Treasury do? Well, basically, they rescue everything.
Yeah.
They certainly rescue the banks. They rescue important businesses, small town stuff that can go to hell, basically. But the big stuff, zombie companies, basically, will be rescued.
Mhm.
And how do they do that? Well, basically by debauching the currency. So we're going to see more of it. I think what we're seeing is the first in a series of steps which are basically leading to the end of the fiat currency system.
A remarkable occurrence is happening in the silver market. Alasdair Macleod believes a single occurrence could signal the biggest structural change in contemporary money. The real story is not daily trade movements, despite recent market volatility and short-term pullbacks. It concerns physical markets, notably London vaults and COMEX trading platforms. Macleod believes the system is more weak than it appears. Nearly 80% of the silver in LBMA vaults has been secretly absorbed by ETFs, leaving a dangerously thin liquidity layer. If ordinary investors raise their ETF or physical exposure, the London market, currently short on supply, might undergo an unprecedented squeeze. All signals exist. As central bank leasing arrangements get riskier and inventories drain from London, the bullion establishment realizes supply channels cannot survive another physical demand surge. COMEX's delivery pressures and gold truckloads leaving the Bank of England earlier this year are no coincidence. Market structures at capacity vibrate like this. Systemic issues include scarcity. Due to unallocated accounts and complicated paper claims that have formed a top-limited physical metal, the bullion market has become a delicate web of counterparty promises where a single spark might cause a chain reaction across the fiat complex. Macleod's analysis suggests that gold and silver are nearing an inflection point, which could show how much metal backs the vast ocean of synthetic contracts. This cycle also sees non-institutional speculators buying. Retail investors, sovereign wealth funds, and central banks are preparing for a long-term revaluation of tangible assets versus paper currencies. Silver is becoming the fulcrum of this revaluation, a metal that is industrial, monetary, and scarce enough to trigger a global price adjustment. According to Macleod's latest assessment, this is just the beginning. He explains in this video why the recent metal's decline has failed to alleviate delivery stress in London, how central banks have been discreetly advised against leasing their gold, and why bullion market liquidity is evaporating faster than most people realize. You must watch the complete video to understand the next phase of this financial change. Subscribe and enable alerts for more global metals news.
Repos spiked up to 29 billion
Mhm.
the other day, um, which was containable. I mean, we don't often see spikes like this, but I think on its own, it really doesn't matter. But there is no doubt that there is a liquidity problem developing in markets. And really, what's contributed to it is two things. Firstly, quantitative tightening, which has
Mhm.
taken liquidity out of circulation, as it were. And the second thing is that the US Treasury has been funding itself very substantially. It's been relying on T-bills for financing,
Mhm.
which, of course, absorbs credit from the money market mutual funds, principally, as well as the banks. But the point about money market mutual funds is that their subscribers basically pay out of bank deposits. So, what you see is that these funds go into the general account, at the Fed, the government's general account at the Fed. And with a lot of government operations in suspension because of the debt limit, at the moment, it's not going back into circulation.
Mhm.
So we're seeing, if you like, a credit crunch, and it's just basically developing. And the Fed recognized this at the last FOMC meeting when it announced not only a quarter point cut, it also said that it was going to end quantitative tightening and replace it with quantitative easing. So that's why. So, which is interesting because the big signal from that is forget inflation. That's not the problem as far as the Fed is concerned. And so they're just jacking up the money printing system again, or the
Mhm.
credit printing system. And I think it's the first real increase in cranking up, the credit system that we've seen for a little while. And
Mhm.
quite honestly, it's going to be followed by more and more and more. And the reason it'll be followed by more and more and more is we have a debt bubble. Well, it's a debt come credit bubble in the markets. They always burst.
Mhm.
Credit bubbles always burst. I don't know when this one will burst. Might burst next month. Might burst next week. It might burst early next year. But credit bubble it is. And when it bursts, what does the Fed and the US Treasury do? Well, basically, they rescue everything.
Yeah.
They certainly rescue the banks. They rescue important businesses, small town stuff that can go to hell, basically. But the big stuff, zombie companies, basically, will be rescued.
Mhm.
And how do they do that? Well, basically by debauching the currency. So we're going to see more of it. I think what we're seeing is the first in a series of steps which are basically leading to the end of the fiat currency system. Forget bail-in. Bail-in is nonsense. I
Okay.
mean, if anyone tried to bail in, um, bondholders in with bank bonds,
Mhm.
would immediately start a run on the banks.
Right.
That's not going to happen. I mean, it could happen, where legislators are stupid.
The precarious state of Western financial institutions is revealed by Macleod's comments regarding liquidity and leasing practices. The assumption that leased gold would always be available for rollover, and that paper claims could be resolved. Through simple book entries has been the basis for the operations of bullion banks for decades. However, that presumption has since been disproven. Many central banks came to the realization that the metal they had leased out might not be retrievable in a crisis when they observed gold being physically transported out of London to meet COMEX delivery obligations. This represents an immense transformation in human conduct. The central banks that previously facilitated Western market liquidity are now becoming increasingly hesitant to lend their reserves, thereby severing a critical supply source for the bullion banks. This constricting liquidity is concurrent with an increasing awareness among investors that the unallocated gold and silver markets are structurally under-collateralized. Some estimates indicate that physical support may be as low as 10%. In the AVCU interim, the demand side has undergone a significant transformation. China, the leader of the East, is no longer satisfied with mere legal claims on metal. While Western ETF holdings continue to consume nearly all available supply in London, physical withdrawals from Shanghai vaults have increased. A global repricing of both metals is likely to occur as the convergence of these two forces, a constricted Western supply pipeline and insatiable Eastern demand, will likely reveal the vulnerability of the fiat-based pricing mechanism.
But this was something that was introduced by the political class in the wake of the last crisis.
Mhm.
I remember Gordon Brown, who was our prime minister at the time, who was claiming credit for, rescuing the world from this financial crisis and all the rest of it. And his mantra was, "You will never let the public have to pay for the rescue of the banks again." Come on. I mean, this it was lunacy, really. And if you create a condition whereby the bondholders say, "Well, to hell with this, we're getting out of this risk," then you're going to collapse the whole system.
Mhm.
So bail-ins, forget it. I mean, it is possible that some stupid regulators in another nation, in a general banking crisis, will try and bail in, and that could have nasty repercussions. But as far as the US system is concerned, It's not going to happen. As far as the Bank of England is concerned, it's not going to happen. As far as the ECB is concerned, it won't happen, and nor will it happen in Japan.
Mhm.
These are the big ones, if you like, and I think that's the important thing.
Mhm.
So I would dismiss that instead. And when it comes to regional banks, I mean, the answer there is that okay, a regional bank may go bust, but the deposit holders will be protected, not by the fund set up to protect deposit holders, but the depositors will be literally transferred to another bank. Another bank will acquire the balance sheet.
Mhm.
Less, less, if you like, some of the bad debts, if the bad debts are transferred, they will be guaranteed or whatever. I mean, the various arrangements they will come to. Um, but I think you're just going to get bigger and bigger and bigger banks, if you like, because the weak banks will all be absorbed. Now, this
Mhm.
is fundamentally different from what happened in the 1930, 31, 32. 10,000 banks went bust, but they were all small regional banks. You just had the new Federal Reserve system come into existence, and if you weren't in it, you didn't get rescued.
Mhm.
You know, not only that, but we had a gold standard, and certainly at 20.67 until 1933, 1934 actually. And that's the difference nowadays. So what happens now, I think, is that instead of banks going bust, instead of bad debts, instead of bankruptcies wiping out credit, credit will be wiped out by its value declining rather than its quantity declining.
Mhm.
And that is inevitable now because it is a fiat currency.
Mhm.
It's a fiat currency to facilitate um, its debasement, really. And I think we're on the last leg. This credit bubble is the largest in history. And on top of that, I mean, it looks like 1929 all over again because we've also got Smoot-Hawley Tariff Act Mark II, courtesy President Trump.
Yeah.
And I think in many senses it's worse than Smoot-Hawley because President Trump has injected huge, great uncertainty into the whole situation. And on top of that, there's America's reliance, if you like, on foreign trade is far greater than it was in 1929, 1930. And furthermore, you've got very sophisticated supply chains, which, you disrupt them and you can have an awful lot of unexpected problems. That
Mhm.
was a situation that didn't really exist in 1930. So I know that US economists who are sort of faithful to the Republicans are dismissing all this stuff about trade tariffs and how it's going to drive up prices and all the rest of it. But I mean they're completely driven by their own vested interests. The reality is it's bloody awful,
Mhm.
and it's going to undermine the US economy. It will do, and inflation is going to soar over the next 18 months. I mean,
Because of
and what
because of
you know,
going because of
well,
going back to QE.
well, it's going to be triggered by all sorts of things. But I mean, basically, yes, QE is one of the things.
Mhm.
But just look at it in very simple terms, and that is that dealing with a credit bubble that is bursting basically will be facilitated by the debasement of the currency. In other words, the purchasing power of the dollar will go down. What does that mean? Prices rise.
Mhm.
It's as simple as that, really. And it's at the moment everybody's saying, well, interest rates have got to fall. I think the expectations, in spite of Powell's caution on the last FOMC statement about a December cut, I think the majority is still going for a December cut, and they're not looking really beyond lower interest rates.
Mhm.
But the fact of the matter is that if you get um, rising prices because the currency is declining in terms of its purchasing power, then you're going to get higher bond yields all the way along the curve. It doesn't matter what the hell the Fed does, but basically the cost of borrowing just soars because it reflects loss of possession of the money. Like I'm lending you the money, so I no longer have it. the risk that you may not repay me, and now the risk I've got to sort of try and work out what is a dollar going to buy me in a year's time.
Mhm.
You know, and suddenly you're looking at bond yields from 10 years outwards going 5, 6, 10, 15, 20%.
Mhm.
I mean, and it probably won't stop there. So this is a time, I think, of maximum danger for credit. Yes, I do. I mean, the reason I chose the Weimar Republic and the Reichsmark and how that declined is that it's the best documented situation of a collapse of a fiat currency that we have.
Mhm.
And really, what you can pick up on it are two things. You've got the political imperative, which overrules any economic imperative, and at the same time, you've got the human response, the human response to what is going on in terms of the value of the currency, and those are constants. Those things are all, the situation today is obviously very, very different from what it was in post-war Germany, post-World War One Germany. But if you just look at it in terms of the pressures on the political class, how things develop, and the interesting thing was that you had a credit bubble in 19 from about late 1920 into late 1921, and it's similar to today. Now, the decline in prices when that burst, measured in falling Reichsmark, was around about a third, 30% drop. But in gold, measured in gold, which is real money, don't forget, it declined by 93%.
Over what time period?
We're talking about over 6 months. They're about 6 months.
Wow.
The magnitude of the situation becomes evident as Macleod transitions into his discussion of China. He predicts that China may currently possess approximately 70,000 tons of gold, which is more than one-third of all above-ground global reserves, as a result of private ownership and state holdings. During periods of Western disinterest, a significant portion of this accumulation was quietly accomplished through a combination of controlled withdrawals via the Shanghai Gold Exchange and domestic mining imports. However, the intent is what is most remarkable, not the quantity. The strategy of China is indicative of a profound comprehension of monetary fragility and a recognition that fiat currencies, particularly the dollar, are unable to sustain perpetual debt monetization without repercussions. China has effectively protected itself from the vulnerabilities of the Western monetary order by integrating gold ownership into its financial and cultural fabric through state reserves, citizen accumulation programs, and a robust domestic refining and trading infrastructure. Macleod's analysis emphasizes that this was not an accident. It was an intentional reaction to the financial excesses of the Western world over the course of several decades. The Chinese leadership, which was influenced by a historical skepticism of capitalism's boom and bust cycles, acknowledged that gold is not solely a commodity. It is strategic sovereignty. The implications are significant. The traditional balance of monetary power will inevitably shift eastward if China's dominance in physical gold is matched by a growing control over silver supply channels, particularly as their exports to Western financial centers wane. This realignment will not occur through explicit confrontation. Rather, it will occur through market function. The pricing authority is transferred to the location where the metal is located when the physical supply no longer meets the synthetic demand. In that scenario, Western futures exchanges are at risk of becoming irrelevant as the true price discovery transfers to Shanghai and other Eastern hubs that deal in deliverable ounces rather than digital claims. In the end, Macleod's analysis converges on a single conclusion. The denouement for fiat money is being formulated in real time. Additionally, the authors are not located in London or Washington. They are located in Beijing. The Western strategy, which has been based on paper markets, leverage, and rehypothecation for decades, is currently in conflict with an Eastern strategy that is based on strategic forbearance and physical accumulation. There will be more than just a market correction when the next crisis occurs. Money will be the determining factor. If you found this analysis to be insightful, please consider liking the video and sharing it with others who are interested in the precious metals sector. Please share your thoughts in the comments section. Do you believe that China's gold dominance will alter the global financial landscape? Additionally, to obtain a more comprehensive data-driven analysis of gold, silver, and the forthcoming monetary realignment, please ensure that you have subscribed and activated notifications. I appreciate your attention.